Welcome to TheoTrade. This is Don Kaufman. It is May 24th, 2017. You are watching the Theo Night video. Let me start by saying if you missed today's trading session, well, at least the intraday trading session, you didn't miss all that much. So the market started off massively unchanged, continued with some massively unchanged, followed by none other than the FOMC minutes. That's right, FOMC minutes came out. And if you look very, very carefully, what happened moments after, well, not much. So some volume kind of picked up and we slightly ground a little bit higher on the trading session. I know if you zoom out over here, this looks like a spellbinding move, but for the most part, we moved from 23.99 to 24.01. If you missed the trading session, it was kind of lackluster out there. However, there are some bigger ideas kind of in play. All right, first and foremost, the S&Ps just ticked short of the all-time high, and this is the SPX in here. When I say the all-time high, for the most part, we hit the all-time high, and we were just, when I say just short of it, we actually hit to 105 and change, but the all-time high was actually hit back here, about 10 days ago at 24.0577. Today we hit the 05, like, what? 05.58, so we missed it by, again, fractions of a penny out there. Nevertheless, the rally in recent trading sessions and the rally back since last week's, sell-off has been nothing short of spectacular. One thing I want to bring to your attention right now, even though it wasn't exactly, again, a spellbinding trading session, we're starting to come close to, and this is Wednesday, and approaching the expected move for the week. So the expected move this week started out here, and the week, again, goes from last Friday's close. Last Friday's close was right around 23.81 in the SPX. Okay, the expected move is right around 28 bucks. Well, we've moved most of that. The expected move takes us right to about 24.10. We closed less than, six handles or six S&P points off that expected move. So one of the things you want to think about coming into Thursday and or Friday is this 24.10 could be a quote-unquote shortable, all right, point, and you really want to think about that at 24.10. And again, that's specific to the SPX. Now, in another kind of turn of events, something happened today that was quite interesting that I'm going to get to here momentarily. And if you're tuning in, you're like, I'm a little bored by today's markets over here. You won't be. What I show you here momentarily. Before I get to that, I also want to mention what's been going on in the bond market lately. The bond market is still trading like it's bond Armageddon, and not to the downside like everybody expected. The bonds, not only did they rally off of last week's sell-off, and again, this massive move from 151.5 all the way back up to almost 154, we're holding it right now. And I continue to reiterate the point, what do the bonds see that the rest of us don't know about yet? The bonds feel like they're still pricing in risk, but come on, we're at all-time highs in the S&P. We're at an all-time high inside of the Nasdaq. Even the Russell turned around. It's not at an all-time high, but even the Russell actually turned around. Not at all-time high, but again, up, okay, substantially the last couple of trading sessions. So the bonds remain a bit of a mystery, but the bonds, as they rally, they are to a degree still holding the financial product back. Now, let's go back to the Russell for just a moment, because there is a very interesting, issue that happened earlier in today's trading session. Only handfuls of kind of industry traders are really talking about this, but something, again, interesting was exposed. And allow me to show you. So here's IWM. I'm going to close up this left side bar. We're going to call this the danger that lurks inside of the ETF products here. All I'm going to do is zoom into this. There happened to be what turned into a minuscule flash crash inside of, it started with the Russell futures and actually reverberated into the IWM and into the Russell specifically. Now, this could have been anything from like a fat finger mistake. What that basically means is somebody came in and instead of selling 100 contracts, they accidentally put in an extra 0 and they sold 1,000 contracts. You know, the idea of fat finger mistake has kind of fallen by the wayside because for the most part, algorithms are trading this stuff today. So this could have been an algo gone kind of haywire. But what I want to explain by looking at this, right, you're exposed and massively exposed when one little algo or one person can come in and rock a product, okay, like the IWM, which is in fact one of the more liquid ETF products out there. I mean, the thing traded 21 million shares today. Again, that pales in comparison to maybe the spiders, but it's still a monstrosity of volume for a $137 product. And the reason I bring this up, all right, to show you how fragile markets happen to be, and I'm comparing right now, the volume in IWM was actually larger than Apple. Now, granted, Apple's a $153 stock, but I wanted to give you an idea and a scale of how important this happens to be. This is a product that dropped 80 cents in a matter of seconds on, again, what we think is a fat finger mistake and or an algorithm gone awry. It shows you, if you will, the instability that exists in today's ETF markets. There is a phenomenal amount of volume that exists in ETF markets, but the ETFs, what do they have to do? They have to go out and buy and sell all the different companies, if you will, all the constituents of that ETF. So if you were to take something like the, iShares Russell 2000, if somebody comes in here and starts selling IWM like there's no tomorrow, the IWM, those people, iShares, have to go out there and do what? And start selling, okay, ultimately the shares of the Russell 2000. And what that would in effect do would create monstrosity of volatility. Well, one of the issues that we have today is that when you start looking at equity products, that is, if you start looking at the stocks that make up the IWM, they're not trading any volume. Everybody that's involved in the markets is actually trading the IWM. Everybody that's trading markets now is concentrating liquidity into the spiders, into the SPX. Have you looked at volumes out there, whether it's stocks, whether it's options? The volumes, okay, are minuscule in the vast number of products, and the volumes are concentrating into products like the IWM. What's the issue with that? If you come in then and sell the IWM, there's not enough liquidity to turn around and sell the stocks. So what happens to the individual stocks? Well, when you come in, let's say iShares comes in and they have to start liquidating some of their shares inside of the Russell 2000. They come in there and sell a few thousand shares of some XYZ stock. When they come to sell the next 1,000 shares, that price is going to drop drastically. This, okay, is definitive evidence of just that occurring. And it's not, okay, the IWM is one of the largest ETF products out there. Think about some of these smaller, no liquidity kind of products. One that really comes to mind, if you guys have never looked at this, right? This, ladies and gentlemen, is junk. There's no liquidity behind junk. What is junk? It's junk bonds, okay? It's garbage debt that nobody wants, and it's really hard to unload. Think about how volatile this product would be if anyone stepped up and tried to sell it. In the days, weeks, and months to come, we're going to be looking at exploring a couple of what I believe to be incredibly advantageous trading vehicles simply because they are ETF products that have very limited liquidity, behind the ETF, making the ETF, okay, susceptible to massive moves in extremely short periods of time. Junk, okay, IWM, spiders, and we're going to go much deeper into this and find the products that are the most susceptible. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.